Hello and welcome to our latest World of Open Account webinar. Delighted that you can join us for this Alternative Finance Learning Lab session on digital bills of exchange in Open Account. My name's John Bressist and I'll be your host this afternoon, and I'm delighted to be joined by some excellent speakers. The session is being brought to you by our Alternative Finance Learning Lab. And this learning lab is one of WOA's special interest groups, sort of special interest areas where you can obtain C-level input, knowledge and thought leadership being shared to you for the benefit of the whole industry. And it's one of 12 such areas within WOA, and it's important for us to have the opportunity to use these sessions to be able to demonstrate to the world the importance of what's happening in the open account arena as it expands and evolves through time. Now, the Alternative Finance Learning Lab has had a busy time. We've had sessions last year looking at the world of funding platforms, how they operate, how they've developed. We've looked at the idea of tokenization and digital assets. How do we make the physical into the digital? Today's session will be talking about digital bills of exchange in Open Account. And the next session after this one, next month, we'll be looking at the latest updates in the alternative finance market. So we're really looking about how things are evolving, how things are moving through time. So I'm delighted that we today are joined by three really well-known and mainstream C-level speakers in this field. Gunnar Collin, who is the head of sales and marketing at Enigio. Don Bujea, who's Managing Director of Trade Advisory Network, and Andre Custerman, who's the founder of Customer Advisory and an expert advisor to WOA. Now, if you do think today's session brings you value, I hope you do please think about very carefully joining WOA, because it's the opportunity for you to obtain many sessions of this nature, but also to join and showcase your value propositions, to share your thought leadership, your knowledge with everyone who's in Open Account, a peer-to-peer group around the world of people who have like-minded interest in developing the industry. Okay, so that's enough from me. I'd like now to bring in the speakers. And Andre, I'll start with you, if I may, and just if you'd like to have a couple of words of self-introduction, and then let's move around the table before we start the meat of the session.
Yes, certainly, John. Delighted to be here on yet another WOA webinar, or webcast, I should say. So my name is Andre Custerman. I'm an independent consultant in fintech, in the fintech space. I've been in that position for the last 5 years now. February 2016, I started after 24 years at Swift, where I was also helping banks embrace innovative technologies. Those have evolved. We have tremendous opportunities now on the technology side to help banks and non-bank financial institutions in payments and trade. And their opportunities are numerous, and the regulators, as we will discuss, are also embracing this change. So delighted to be here and sharing what we see happening in the area of digital bills of exchange.
Thank you. John, please tell us about yourself.
Yeah, thank you. Good afternoon. I'm John Bujea, also now an independent consultant, have been for several years, working with my colleague Lionel Taylor, co-founder to Trade Advisory Network. I'm what we laughingly refer to as a recovering banker. So after 40 odd years in mainstream banking, in trade finance, supply chain finance, training and education, I managed to escape. But I'm still involved in trade finance, and now we work with banks, fintechs, technology service providers, and corporates and educational institutions, industry bodies, and so on, to try and help develop the industry, the capability of the industry. And digitalization is certainly a red hot focus right now.
Okay, thank you. And Gunnar, yourself, please.
Yes, hi everyone. Delighted to be here. Thank you, John. So I'm also, you could say, a recovering banker. I spent over 30 years in the financial industry. I was mostly focused on operations in general and trade finance operations in particular. And since 2 years now, I'm working for this small tech company, Enigio. And this is really interesting, and I will get back to that a little bit later. But just a few words about Enigio. We are, as I mentioned, a Swedish-based tech company. We've been around for almost 8 years now. Sort of the backdrop and the background of the company is really around archiving and digital archiving. So my colleagues, they're really very deep into everything around data, and how do you manage and how do you store and how do you archive digital data through time. And this has sort of made us come up with a solution that could actually solve a real problem when it comes to digital documents. But I get back to that, so thank you.
Okay, Gunnar, thank you very much. And thank you all of you for joining in. Let's start the discussion. This idea of digital bills of exchange, let's sort of wind back for a moment and say, let's go back. John, can you tell us a little bit about the background of this? What really are the background to bills of exchange, negotiable instruments? How are they being used? Where do they come from? What are the regional differences, etc.? Why are they used? What are they used for? A bit of a background.
Okay, so let's start with a bit of a definition. So we're talking about negotiable instruments. There are really two types of negotiable instruments. There are negotiable payment instruments, and then there are negotiable documents of title. And they do have certain things in common, but they do serve a completely different purpose. We're going to focus on payments instruments initially, at least, and for the bulk of this discussion. But I will mention documents of title as well later on when we talk about how we can incorporate digital payment instruments, bills of exchange, into a financing solution. So the key word there is negotiable. So what does that mean? It confuses a lot of people because people think of a more common English interpretation of the word negotiation, which means like striking a bargain between two parties. It doesn't mean that. In this context, it means something is negotiable when the title rights embodied in a piece of paper in historic terms can be transferred by delivery to a new holder. So a new holder then has possession, and they acquire the title rights associated with that instrument. Now, in the case of a bill of exchange, promissory note, a payment instrument, the title rights are the right to get paid. In the case of documents of title, they are the right to take possession of goods. And that's where the similarity, if you like, is, but also where the differences are. So the two types of negotiable instrument, the most common is the bill of exchange, but promissory notes are also used. And they differ in a key way, but they're actually subject to the same legislation in most cases. So a bill of exchange is drawn by the seller, known as the drawer, on the buyer, known as the drawee. And upon acceptance by the drawee, the acceptor becomes liable to pay. Basically, that's how that works. A promissory note, on the other hand, is issued by the buyer in favour of the seller. Mm-hmm. So it's a slightly shorter process. In England and Wales, they're both subject to the same legislation, which is the Bills of Exchange Act 1882. And similar legislation exists throughout the world, really, in the vast majority of markets. So if we move on to how are they used, why are they used, who uses them, I'm going to give you a slightly weird example, first of all, of a promissory note that is still in use today in the less developed regions of an otherwise developed economy, such as here in the Cotswolds where I'm now sitting. And that's a promissory note, basically a banknote, a £10 coin. Obviously, I rarely actually deal with anything less than a 50, but for purposes of this demonstration, I thought I'd get a 10 out. And the key characteristics, the banknote illustrates why negotiability actually is important. A banknote is a unique type of promissory note. A, it's issued by the central bank, but secondly, it's payable to bearer, which means I can transfer the title rights, which is the value of £10 to anyone. They can now spend this £10 irrespective of how I got hold of that £10 note. That £10 note has title rights which are freely negotiable, and it's simply by delivery. I give that £10 to somebody. The fact that I cheated at cards and won this £10 does not change the value of that £10 note. So once I've passed possession on to somebody else, they have title rights. They have the right to spend that money. It's unconditional. There are no conditions attached to that. It's irrevocable. The Bank of England cannot say, we're not going to pay that. We're not going to honour that. That's no longer legal tender. And as I've just explained, it's independent. It's independent of any underlying contractual obligation which resulted in me receiving that £10 note. Those are the characteristics which make negotiable payment instruments so important. We don't use banknotes in international trade, other than in some niche businesses which banks prefer not to get involved in. In trade, we don't use bearer instruments terribly often either. We tend to use instruments like bills of exchange or promissory notes, which are payable in favour of a party. The most common is the bill of exchange, so let's focus on that. They're issued to order. So as I said before, they're created by the drawer, drawn on the drawer. They have to be in favour of somebody. And the typical use of a bill of exchange is to make them in favour of to order, which means to the order of the drawer. A drawer then endorses it on the back, and if he endorses it to another party, he can now deliver that. So another party has possession. That party now has title rights, the right to get paid. If they endorse it in blank, it becomes a bearer instrument. Again, rarely used in trade. So negotiation means to transfer by endorsement and delivery, ignoring bearer instruments for a moment, which don't require the endorsement. If we now look at trade, particularly international trade, because international trade is more complicated, and compare it with domestic trade, as a consumer, I can take this £10 note and buy something, and I'll just exchange it. I'll take the goods and deliver, and we'll let go at the same time. International trade is difficult in that world. You can't easily arrange for a seller to release goods and simultaneously get cash, because the seller generally has to release goods to a carrier, and then there's a transit period. So he's already lost physical possession. He might still have control, but he's lost physical possession. The vessel may take weeks to arrive if it's going to the Far East, for example. And then the buyer might want to take a couple of weeks, up to 6 months for many goods to actually get paid. So that creates a funding gap, but it also creates a risk. What the bill of exchange is used for, traditionally in traditional documentary trade finance, is to create a scenario whereby the goods can be released, i.e. the documents of title can be released against acceptance of the bill of exchange. And once that bill of exchange has been accepted, the seller, through their banking system, their banking partners, now has irrevocable, unconditional and independent rights to get paid. So they're now protected. Doesn't mean they will get paid, because the buyer can still go bust. The buyer can still default. But what they can't do is decline to pay by alleging contractual dispute. They can't say, I'm not paying this bill because the goods didn't quite work in the way they were supposed to work. So one of the big risks in invoice discounting and factoring, of course, is exactly that, where there is a performance dispute and the buyer then says, I'm not paying. Well, if you've discounted a receivable as a bank or a non-bank finance provider, you are susceptible to the same risks that the seller is. You're exposed to the same risk. You're exposed to the risk of non-payment because of contractual dispute. With a bill of exchange, you're not, once it's accepted. If you finance before it's accepted, then you are. But you can finance before on a with recourse basis, for example, or afterwards on a non-recourse basis. You can connect this is getting into more trade finance sort of technical territory now, but you can link the the accepted bill to the insurance. As long as the policy is worded in the right way, you can use the dishonored bill as basically prima facie evidence that the debt was due, which is always a condition of the insurance, and it wasn't paid. So that's basically how bills of exchange have been used in the past. So why aren't they used more, I guess, is the question. Why are they no longer used? They used to be used universally. All global traders really handled on this basis. And a letter of credit is a more secure way of achieving the same thing, which gives you pre-shipment risk mitigation as well as post-shipment risk mitigation. The difference between a DA collection, DA stands for Documents Against Acceptance, and an LC is that there is no bank undertaking that this instrument will get paid. With an LC, there is, and therefore you have a set of documents which are checked against the letter of credit. And if the documents comply, then they will get paid. And often there is a bill of exchange in the background for a usance or a term LC, which can then be discounted. So why did we stop in developed markets like the UK, EU, North America? Why do and even now many parts of Far East, why do we no longer see bills of exchange? Well, the answer is they're uncomfortable to use because they're paper and they are expensive to use. They're prone to fraud. I mean, that I could photocopy that.
Yeah.
Okay, no one's going to agree that's a genuine £10 note, but if it was a bill of exchange, I could fraudulently create a bill of exchange. It'd be very difficult to tell. I could create a fraudulent bill of lading, very difficult to tell. So paper-based instruments like this are great in lots of ways, but they're awful in lots of others. So think about the archiving that you need to do with paper, the filing, the retrieval, the secure storage. If I left that out on the bus or on the underground, it'll probably get stolen. And now I've lost it. I can't claim it back from the Bank of England because it was stolen. You know, it's gone. Well, it's the same with valuable instruments like negotiable payment instruments, bills of exchange, and prom notes, and so on. You've got to look after them. If you lose them, you don't have them anymore. You've then got to move them across the world. Well, that's a pain as well, because that could take several weeks. And then it's not very green either. I mean, it's highly unsustainable to be printing lots of stuff, often multiple times, developing systems to control the multiple copies, original and 25 copies dotted around the place, then moving it. Whole process repeats and repeats and repeats. Very, very, very inconvenient, very slow, very prone to fraud, very prone to error. A bad idea. But we shouldn't forget that paper does have certain advantages. And the main ones are that I can receive a piece of paper. I don't need to be a member of a club. I don't need to be operating on a certain platform. I don't need a special system on my laptop or my iPad in order to read it. I can just read it. End of. And it's legally enforceable without debate. I don't need to sign a contract in order for this to be enforceable. I don't need to check with a lawyer. It's there, it's in writing, it's signed, it's enforceable. So there are some advantages. And that's why bills of exchange are still heavily used in high value transactions, complex transactions, higher risk transactions. And a little later on, I think we can explain how a digital version of a bill of exchange or prom note can be used in an open account context without some of the heavy lifting that the banks are accustomed to doing with traditional documentary trade. So hopefully that gives you a good overview.
Yes, thank you. I think that gives a real good picture of development of it and the advantages too. And so I think that the question is, okay, you've got a system that's got some pros and cons. How then do we sort of bring that up to the modern age? How do we look at technology digitizing these negotiable instruments? And is this something that's going to be based on DLT technology? Is it other ways of doing it? Gunnar, what are your thoughts on this?
I have a lot of thoughts on this, so I'll try to explain this as well as I can. But as I mentioned in my introduction, what I would say is that when we think about going digital or digitalizing something, everyone immediately, when we talk about documents, they look at what's written on the document, right? The text, the content. And when I look around, what everybody, I'm saying everybody else, but what is usually going on is that everyone is trying sort of to extract whatever is written on a piece of paper, take that data and start managing that data between the parties, right? And in order to do that, you need sort of to manage the data, you need to put them into a system or a register, and then everyone has to agree on how to do this and how to interchange these data extract, if you wish. And that's fine, that works in very many contexts. But what everyone seems to have forgotten is that the paper in itself has a lot of important properties. So we have been focusing on digitizing the paper. not
Okay.
the content. So we have been focused on the paper. And how do you digitize a piece of paper? Because you must remember that a piece of paper is really, really convenient. I would say it's one of the best standards that we have, because everyone immediately knows, because you, John, you probably have papers on your desk right now, right? And you have those pieces of paper. I don't. And you know exactly what's written on those pieces of paper. I don't. And furthermore, if you can pick up the piece of paper and you know what's written on it and what's not written on it. So the paper sort of defines where the sort of content starts and where it ends. And it also makes it possible, as John Bajea clearly explained, how you can actually transfer this to someone else. So we have been focusing on digitizing the paper, and that might sort of seem like a very easy peasy task, but actually it's not. Because there are a few things you need to be really, really careful about, and there are a few things that you must be able to replicate. And you cannot just do some of the things, you need to do all of the things. And the first thing, as John Bajea mentioned, is that you need to be able to distinguish an original from a copy. And if you look at sort of all the solutions that are out there today, you can create a really, really good PDF and you can make it really secure and everything else, but you can make a zillion copies. And therefore it doesn't really work for a negotiable instrument or a document of title. So that's the first thing you need to do. You also need to be able to prove possession. So I need to be able, as you have papers on your desk, I need to make sure digitally that I'm the owner of the original and you are not. Mm-hmm. But it doesn't stop there. I need sort of to solve the problem of transferability. So I need to be able to hand over the original to you digitally. And you, at some point in time, probably you would have to be able to stand in front of a court of law and prove that you are actually in possession of this digital document. So these are the things that we have technically solved. But there are a few other things that are really, really key to the solution. Is that, first of all, the content of the document, the digital documents that we create, is immutable. So once it has been written, it cannot be changed. So it's practically fraud safe. Also, the document in itself has the full traceability. So you will know exactly what has happened to it. And if you think about sort of the physical world, if you get an original paper in front of you, you will see everything that has been done to this particular paper. It's exactly the same thing with our digital originals. And the last piece here, which is, I think, quite important these days, when these documents are created, the content is in the document. It's not somewhere else, okay? So the document will keep the content in the document. And that's extremely important if we think about business data, because maybe you don't want sort of to spread your business data somewhere else. And it's particularly important when it comes to personal data, because you would need to be able to sort of erase the data. So you shouldn't, if you put the data on a blockchain, for instance, you will have a problem because you cannot erase it or you cannot backtrack it. So these are the key things with the digital documents, or the digital paper, if you wish. So the way we do this, and if you think about the paper document, we use a file, a normal file, any type. Then you write something on your piece of paper. We just add content to this digital file. That's not very complicated. But in order to be able sort of to know what data sits in this particular file, we use, now it's getting a bit technical, so we hash the documents. We create a cryptographic one-way function. And with this hash, you will be sure about the content, what's the content and what's not the content. And you can also use this hash to prove afterwards that the content hasn't been changed. Also, as I mentioned, my colleagues, they're really into this archiving, so they invented a blockchain. So we use distributed ledger technology, and we use blockchains, but not for storing business data or personal data, only to publish the evidence of the existence of the document. So that's the first thing we use the blockchain for. And therefore, it's kind of a notary service. So the blockchain wouldn't know anything about business content or anything else, but it can be used to verify the document and making sure that you have the latest version or the actual original. Another key feature that you need to be able to do, you need to be able to sign the document, right? So in the physical world, you sign it with wet ink. We can add any type of electronic signature to the document. And the key thing with this is that since the solution works exactly the same way as it does for paper, you will read the content and then you will sign it digitally. And this digital signature will become an integrated part of the document, and then it will be hashed again. So the signature is sort of a part of the document, so it doesn't sit anywhere else. And this is also a key feature. The last thing that I just wanted to mention in this context about technology is that we also use what is known as cryptographic key pairs. And this is the way you can prove and make sure that you are the holder or in possession of the original. Because into the document also goes a public key that is written in the document and also published on the ledger, and you keep your private key. And that means every time you want to write something on the document or add a signature or transfer it to someone else, you use your private key. And then if you're going to sell a document to Andrea, for instance, what Andrea has to do is he has to give you a public key from a key pair that he has created. He will not show you his private key, and you will write the public key in the document, and that will get published on the notary service. And once that is done, you can send the document to Andrea, and then he will be in possession of the original, and he can continue writing on it or doing whatever he wants. So basically, these are the technical components that work together in order to recreate sort of the paper digitally.
Okay, thank you. So, we talk about there the content, the originality, authenticity, immutability, and the role of cryptography in maintaining that. A complex area. So, Andre, I mean, how are banks embracing this sort of technology, and how are they working with it? How are they making it integrate with their existing infrastructures?
Yes, hi, John. So it's both a very simple process and it's also quite a challenging process. I mean, from a technology point of view, and I will answer the question this way, it's quite simple, and I will expand on that. From a legal perspective, it's very complex because of all the reasons John explained in terms of transferability or transfer of possession. And of course, Gunnar has already provided some of the hints around how technology addresses that. Now, the way I see it, because I've been working on this for more than 18 months now, is the key thing for banks and factoring companies is technology integration. Because banks and factoring companies have already technology in place, and digital originals for negotiable instruments, bill of exchange, prom notes, and potentially other documents as well, is definitely yet another digitization effort. But the most important is that it can be seamlessly integrated into the existing IT environment. And that's why, indeed, the major trade vendors like Finastra, China Systems, and others are critical for that, because in the same way as they have integrated electronic signatures for some processes like signing, whatever, a contract on the portal or a payment run on the portal or any other type of transaction. Now, and electronic signature technology has been integrated by those vendors and by banks and are used seamlessly by end customers. Now, the evolution is to go one step further and not just to offer an electronic signature on any content like a PDF or a scanned copy of a paper contract, which is still often used. The goal is to go the next step and to say I'm signing a digital asset, something that only exists in digital form. It's not coming from a scanned piece of paper. It has been created fully electronically. And because of the technology that I will not expand on here, we can prove it is the only version of that original document. It is the original, in the same way as when John explained, I can create a new bill of exchange, and that would be a new piece that is unique as such. So technology integration is key. It is quite easy to perform because it is replicating the approach. I see that in that way from a technology perspective, it is replicating the approach that banks have already taken and factoring companies have taken to integrate other technology components. And the ones that is, in my view, quite interesting here is the electronic signature. And we're going now to integrate electronic original. It's a bit more complex than electronic signature. It embeds electronic signature, but it contains document technology, as Gunnar explained, as well as a DLT. And we'll come back on that a bit later. So technology integration is the way to go. We are not here talking about selling yet another cloud platform to the banks and telling them, if you all join that single platform, the issue will be solved for the whole world. That doesn't work. Banks do want to own their data, own their systems, and that's how it's going to work here for digital negotiable instruments.
Okay, I mean, yeah, very much so. I think that point about control and keeping the process within the arm's length is something that I find is very important to organisations. So we talk a little bit about the sort of the hows there, the process side of it. John, I can come back to you again. I mean, how would you see, the what of this? I mean, how would digital negotiable instruments help, for example, factoring companies, and what new propositions could they produce from them?
Okay, I think there are several value propositions or use cases which could add real value. So we start at a relatively simple, typical invoice discounting, cross-border invoice discounting scenario, all the way through to a sort of open account equivalent of a DA collection. You can have all shades between those two extremes. There are also applications with payables finance or supply chain finance, as it's often called, which I maybe touch on at the end. But let's start with the basic, simple proposition. Today, if you're a finance provider in the invoice discounting factoring world, and you have a client that trades internationally, with the best will in the world, the standard invoice finance proposition has its limitations, especially if your client is trading in markets which are maybe have different legal jurisdictions. It's difficult to take an assignment. You don't have people on the ground. It's a challenge. You might solve that by operating the two-factor model, which is fine. Nothing wrong with that. Works. When it works, it works. The problem with that is you're giving away most of the income, obviously, so you'd like it to be reciprocal, but it might not be because you're possibly sitting in a nice developed economy where the problems don't exist and the counterparties are sitting in a more difficult, more challenging environment. So getting reciprocity might be a bit of a pipe dream. But where it works, it works. So there's definitely nothing wrong with it. You've still got the problem wherever the buyers are located, wherever the two parties are located, of this performance risk, this dilution risk element. So if you look at all of the challenges associated with cross-border invoice finance and think, well, is there a better way? Well, I think the use of a digital bill of exchange is a better way, but without the heavy lifting of the bank involved. So I just run you through what the high level, there are lots and lots of steps, most of which will actually be hidden from view because they're buried in a workflow. They're buried in one of the bank's existing platform, the customer's ERP system. They're not actually visible to the naked eye, but they're important to understand. So the first thing that would happen is that the seller, they've got to create all their documents anyway because they're shipping goods overseas. So they're going to create their documents. They might have to do that in paper. They may be able to do that digitally. For the purposes of this example, it doesn't matter. But one of the documents they will create is actually an electronic payment undertaking or electronic bill of exchange.
Mm-hmm.
And they don't print that out ever. That never gets printed. They then deliver the documents, preferably digitally, but not necessarily. If they can't, they'll get the documents across to their buyer, and they deliver this EPU. I call it an EPU because for the reasons Andre alluded to regarding the legal interpretation, which again we can talk about later on if we have time. You can't call it a bill of exchange for one reason. It's a legal obstacle, but let's call it an EPU, electronic payment undertaking. So you then deliver the EPU to the buyer and invite them to accept it. And that's similar in some ways to them acknowledging an invoice, acknowledging that the invoice is properly due. And obviously the finance provider prefers it if the invoice has been approved in that way. But if they actually accept the EPU digitally using the technology that Gunnar alluded to, you've then got an unconditional, irrevocable and independent payment obligation rather than simply an approved invoice, because they can still have a contractual dispute later on, or they can have set off, they can have counter claims, they can have all sorts of things. With the independent instrument, that all of that goes away. The customer then gets that back. The seller gets that back. If they don't need finance, what they've achieved is some nice, good risk mitigation. They might not need finance. If they've got credit insurance, they can link the two together, enhance the risk mitigation even better. But as we know, most SME and mid-cap companies do need finance. They do need working capital. So they can then deliver that EPU to the bank, again, digitally using the cryptographic key pairs and all the clever stuff, which I don't profess to fully understand. And the bank can then lend against it. They can discount it. They can buy it, or they can treat it as security. In the same way that would happen in the paper world. So if they discount it, they buy it, then they now have title rights to get paid, which are that there is no legal defense against them. The buyer can say what they like, they're still obliged to pay unless they're bust, but you can insure against the risk of them being unable to pay. So what you've basically got there is the light touch solution, which looks and feels quite a lot like invoice discounting. Because this business of the cryptographic keys and the signing and the transfer of ownership, that sort of happens pretty much below the surface. People don't need to. If the platform that the bank is using for their invoice finance proposition has been well designed, it's just a tick box. Would you like an EPU? Yes, tick. So it needn't be complicated. It still requires some effort to change procedures, but not really materially. It's still fundamentally an open account transaction. So they get their finance that way. So the bank now has a proposition which hopefully will give them greater appetite to do business in markets where previously they would struggle. Or previously they might say, I'm only financing that if you do a traditional trade finance solution. We want a full LC, or we want a full document against collection, DA collection. You can basically operate in the same way as you always have done, but with that assurance of an independent instrument. The bank then presents it with payment to maturity. If he doesn't get paid, they've got a credit risk there, which they have anyway. They can insure that or self-insure that. That's the first model. That's really simple. The way I describe it is really simple. It'll take a bit of setting up, but it doesn't mean we're revolutionizing the way people do business. It's relatively easy to adopt. The second one takes it one step further. And if you go back to my what I said at the beginning about ideally the two parties would exchange control of the goods for cash, well, you can actually replicate that. And you could do it without the bank involvement using the technology. The bank might provide the platform over which the customer transacts, but the bank doesn't need to handle the digital documents necessarily if that's not required. But if you were to include an e-bill of lading, which is also digital, and today that means using one of the many providers like Bolero, Estox, or one of the others, Wave, I think is another one. And you can effectively arrange for the release or the transfer of title as set out in that e-bill of lading to be simultaneous with the acceptance of the EPU. So they don't accept the EPU, they don't get title to the goods. So this now gives the seller protection against loss of goods and then non-payment. or a failure to accept the bill. You can link the two together, and the rest of the processes, they're pretty much the same. You can take it a step further and have the bank handle those digital documents for you, which probably would be more sensible, because the bank's platform will facilitate that. The bank has the correspondent relationships, so all of that becomes a lot easier. And this is now, beginning to look more like a DA collection, but without the delays and the errors and costs associated with dealing with paper. So those are three for the export sort of scenario, and there will be more. Those are just literally a few that we thought of over the last few weeks, but there will be other applications. You could possibly use the same sort of methodology, same approach for payables finance. So today, you're the bank, you're the finance provider, you have a buyer, that's your anchor buyer, and you're busy trying to onboard lots and lots of suppliers all over the place. Well, just imagine that instead of having these complicated tri-party agreements or parallel agreements between the parties, you actually create a process whereby the buyer creates an EPU, a prom note, if you like. Instead of just approving the invoice, they create a prom note,
right,
an EPU. They deliver that to the seller, and the seller then has the option to present it to the funding bank or the platform, the third-party platform that's managing the process, in order to get paid early. But you've then got the benefit of an unconditional, irrevocable, independent instrument, which is the basis on which you're recovering, you're reimbursing yourself on the buyer, rather than a facility agreement. So that might make onboarding and due diligence on the sellers a little bit more effective. Let me switch that off because my wife is not here. Right. That's one of the disadvantages.
One of the advantages of showing that this is a real live session.
It is a real life session, and it's also illustrated. We were talking before we came on air, the advantages of working from home. That's one of the disadvantages when you're the only person in the house at that point in time, and the phone starts ringing. Somebody's asked a question I just spotted: how do you protest a digital bill? I mean, the process of protesting is enshrined in law, in common law, and you would have to show that you invited the obligor, the buyer, to accept this digital equivalent of a bill of exchange. Note on the digital paper, as Gunnar said, you can write stuff on it. Note the fact that they did not pay it, and that file with the notary service behind it, with the audit trail and the cryptographic keys and the hashes and all of that sort of stuff, you then take that to the judge, to the courts, and say, here you are, I did present it for payment, it wasn't paid, this is the reason given, or I couldn't get an answer out and they just didn't pay. So here's prima facie evidence of the debt. Now that from a technology point of view, there's no problem with that at all. The technology will allow that. The challenge with that is that the law hasn't necessarily caught up in all the markets. And if we take the UK, or England and Wales more accurately, to start with, Bills of Exchange Act was written in 1882. It didn't envisage a digital document.
No.
So bills of exchange and prom notes existed before paper, by the way. So they existed in Babylon, carved on slate tablets. So it doesn't necessarily mean something in writing has to be on paper, but the Bills of Exchange Act sort of assumes that. But that's not the problem. The Bills of Exchange Act only mentions paper once in the entire act. I think I'm right. So somebody will probably check that and say it's mentioned twice. I think it's only mentioned once. It's mentioned once in the context of inchoate bills, a very obscure paragraph of the Bills of Exchange Act. It does talk about in writing, but critically, it talks about delivery. To negotiate something, you have to be able to deliver it. And under English law today, you can't have possession of an intangible. And if you can't have possession, you can't transfer possession. So you can't call it a bill of exchange. Therefore, and protest is something which happens in the context of the act and the equivalent act in different markets. Now, different markets may well have moved faster than the England and Wales, and may well say, actually, we recognize the digital equivalent. So the process is exactly the same, so long as the properties of paper are preserved. And that's the key. You can't just use any old electronic record and call it a bill of exchange.
Fair enough. I was going to ask Andre in a moment a little bit about the aspects of regulation, because it's one thing talking about a process and how you can achieve something from a technological or a physical perspective, but actually how you do that within the context of a legal and regulatory environment. But just one very quick point, John, before we move on, there was the other question from Tony, which I think, again, just comes back to where you are in the power chain of this. Is it what's in it for the buyer? You can see what's in it for the seller of having an EPU, but from the buyer's perspective, again, is that going to be more attractive?
Well, it reduces some of the buyer's flexibility to mess around, because they can't now claim contractual dispute once they've accepted this EPU as bill of exchange. On the other hand, they're now if they're generally honest and trustworthy, that shouldn't be a problem. It does mean that they can potentially demand extended or longer payment terms, and it also means that they don't need to go to the next step and have an LC. Yeah. So if you think about, I mean, you wouldn't need this solution for domestic invoice finance in the majority of cases, because you're not reliant on shipping documents anyway. There isn't the time-consuming delays. All of the complexities of international trade don't really arise. You could still use it, but the benefits are reduced. Everyone understands, because it's in the same country, the legal framework, the accounting framework, visibility of the transaction is good. The problems are nowhere near so great, but you could use it. But in a cross-border context, I mean, if you were advising a new exporter exporting to the Philippines for the first time, would you recommend open account?
Probably not.
Probably not. You'd probably say,
Okay.
Look, go for advance payment or an LC.
Yeah, I think so.
And that's probably still good advice. But rather than sticking with that model forever, you might say, well, actually, let's use a bill of exchange, but let's do it digitally. And let's benefit without causing the buyer massive stress and strain on their banking facilities.
Yeah, fair enough. Okay, Andre, let's move on, because I'm conscious that time is moving on. This point about regulation and lawmaking, are the regulators embracing this idea of digital originals or assets? What's the progress on this?
Yeah, this is an important point, John. The regulators are key, but in the short term, indeed, the EPU solution that we just discussed offers a legal framework based on contract law for moving functionally equivalent negotiable instruments to the digital world. Now, of course, the regulators are looking at how the technology world is evolving, and they are trying to catch up, and they are catching up, but in a very unsynchronized way or desynchronized way. That means, for instance, Germany has progressed very well on accepting DLT in capital markets, but not yet for negotiable instruments. Countries like Singapore are progressing on the trade finance side for some instruments. Abu Dhabi Global Markets is looking at this seriously as well, and the UK as well is looking at embracing those technology options that we discussed, so that the Bill of Exchange Act would recognize digital ownership of an asset representing a bill of exchange or promissory note, or potentially other types of assets through tokenization for other markets. So for the regulators, it's a global issue, how to integrate those new technology options across the board, not only in trade finance, but also in other financial services. But this is progressing. So banks are now starting to get ready for this regulatory change that will enable, indeed, banks to leverage not only electronic signatures, that's a done deal since a long time, also with the eIDAS regulation in Europe, but also DLT for digital assets or virtual assets. And transfer of possession and ownership and all those features that are critical will be fully digital. There will be no paper anymore. and the negotiability will be based on the Bill of Exchange Act. That's the goal. That's what the regulators are working on. We expect some good progress in the short term. And that was my dog.
Okay. making his views felt. Yes.
Exactly.
He thinks the whole thing's rough. Okay. Okay, Gunnar, I suppose this is the point. You know, in terms of the operating environment that we find ourselves, you know, the regulators obviously have a certain level of interest. The users, the potential users of such systems, obviously come at it from a perspective which you hope is aligned. But the regulators and lawmakers do need to understand the needs of the users and the providers. How do an interested financial institution engage with that? You know, what is the way of actually trying to influence the developments?
There are several ways, obviously, but before I get into that, I just wanted to mention a little bit of a different thing. First of all, the solution, the way it works, is that the only one that needs to be a customer of ours is the one who's actually issuing the paper. So you have to come to us to buy the digital paper. But once you've done that, the document is freely transferable to anyone without any associated costs or strings or anything else. And I think that's really key. So it's quite safe, I would say, to check out the solution and see how it works. And if you want to do that, you can come to us, or you can go to China Systems or Finastra. They have all integrated our solution, or you can engage with International Trade and Forfeiting Association. And this is actually what is happening now. We're setting up a special group where you can test the solution and you can interact with other parties as well, if you wish. I think that's a really, really good way. When it comes to influencing, I think that the main thing, at least from my mind, is to make everyone aware that there is actually now a solution that is equivalent to paper. The only thing is that it is not paper. And when we look at this, if you look at Europe, for instance, you have the EIDAS regulation where you cannot be denied legal effect due to the fact that it's not on paper, that it's sort of technology neutral. So I think for everyone interested in this and trying to sort of push this forward, I think the key thing is just to think you don't have to change everything. The only thing that is required is the neutrality in terms of technology.
Right.
And make sure that you're looking at a solution that actually can how should I say, be compliant with current laws and legislations. And this is also one of the reasons that we are very, very much engaged in the UN's model law for electronic transferable records, because that law actually lays out sort of how you can do this, provided that you have a solution that sort of fulfills the requirements. Mm-hmm. And it doesn't have to be more complicated than that.
Okay. Mm-hmm. Okay, Andre, I think we're starting to come to our conclusions here. I think what I'd ask you then is again, we've talked around a little bit of the theory and the opportunity here. What sort of use cases do you think that actually might appear attractive short term, relatively easy to assimilate options for financial institutions?
Well, what I've seen as we have progressed with various financial institutions, large banks, but also corporates over the last 18 months, I see two categories of use cases. With the large corporates, they handle high volumes of documents on the guarantee side. And the same type of technology, digitizing the document, demonstrating it's an original document. And although it's not a negotiable instrument, a guarantee is not, it's still important to digitize it. And I've heard more and more corporates working indeed on digitizing guarantees as a first step into this document digitization journey. And of course, the next steps will be the negotiable instruments. So that's for the large corporates. And this is to address really the issues of paper. Storing and navigating through this data when it is on paper is very, very costly and cumbersome. On the SME side, and definitely for the WOA community that own the members, the WOA members that own the mid-cap and SME market, for SME financing, as John explained, a digital solution will be very welcome, because the SMEs will sign whichever contract functionally equivalent of a bill of exchange. They will not care so much about Bill of Exchange Act or not, common law, contract law. So I think the opportunity for WOA members on the factoring side, on the banking side, to deliver new options to those SMEs and mid-caps in a fully digital way is very attractive to their clients, and I would think those new options, whether it's again on the contract law or a bit later on the common law, depending on the countries, will start with the SMEs and the mid caps rather than with the large corporates.
Okay, that's interesting, because again, I think it's going to be a question of how this comes in. John, just a few last words from you. I mean, what do you see as the way that this will develop? How do you see the short-term horizon?
Well, I think with any technology-based solution, adoption can be quite slow because banks have procurement functions, they have technology departments, and they need to get comfortable. And if we look at the guarantees example, the hurdle isn't really the applicant for the guarantee, because it's really relatively easy to switch from a paper-based guarantee to a digital original guarantee. The challenge is persuading the beneficiary of the instrument that it has the same value, and they get some benefits from having a digital original guarantee in their files rather than a paper copy, which can easily get lost. And when they need to make a claim, they can't find it, they can't return it, so it can be cancelled, all those sorts of things. So it does take time. I think the low-hanging fruit is the guarantees, because there are fewer parties involved, and there are no legal question marks. I think where the legal question marks arise, the big change will come certainly in the UK, when the law catches up. And I think as Gunnar said, or maybe Andre said actually, we're expecting the first draft of the legislation to allow this in April. So they're moving relatively quickly. It doesn't require a bill through Parliament. It requires, I think it's called a statutory amendment, which the Minister of Justice can sign. But there's a huge consultation process going on at the moment. So we're probably still a year, maybe 18 months away from the law actually being changed. Once it's changed in the UK, the other markets whose Bills of Exchange Act is based on the UK model, like India, Singapore, and so on, I think the interpretation will quickly follow suit there. Singapore will probably get there first, because they're already thinking along those lines. That will accelerate the acceptability because it's now subject to common law. I think the pandemic has, in some ways, accelerated the potential adoption, because the dependence on paper has become less and less acceptable as more and more people work from home, and as couriers find it more difficult to carry large loads of paper documents all over the world. So actually the receptivity amongst the people that we talk to has increased over the last year for that reason. I think another reason why this will accelerate over the next year, 18 months, is the fraud issue. In many markets, fraud is a huge problem, particularly in the commodity space, but not just in the commodity space. And the fraud centers around paper. The inability of a bank to differentiate between a genuine document and a fraudulent document. Well, if you can eliminate that uncertainty, then you can do more business. And that can be on an open account basis, or on a traditional documentary credit basis as well. So I think all those reasons make it likely that there will be accelerating momentum towards adoption. but I don't think it's going to be a big bang. I think it'll just be a drip feed to start with, and then gradually it'll turn into a stream, and then hopefully eventually a flood. And then we'll all be very happy. And I think that where the confusion arises to a degree is that people see this as another platform, which it isn't. It's not a consortium. It's not a platform. You don't need to be members of anything in order to use this solution. It's freely transferable. It's like paper. You need the technology to create the digital document in the first place, but once it's created, it's freely transferable. You need the technology to produce a piece of paper as well. You need a big factory that's terribly unsustainable. So that's the comparison, but people don't understand that, and it takes a while to be able to differentiate between a DLT solution, which is platform-based or club membership-based, where the data sits on the blockchain, and everyone has to be a member of the same club and sign the same rule book in order to transact with each other, on the one hand, and using a digital original document on the other, where it might still be subject to contract law, but the contract's written in the document. So you don't need to be a member of anything in order to agree to be bound by that contract. And that contractual solution is a temporary measure until the Bills of Exchange Act is more workable. So I guess if I would just go back to my analogy about the £10 note, a platform situation or a consortium situation is a bit like me taking my £10 note into the pub and ordering 2 pints of lager and a packet of crisps. An old song from the 80s. Don't worry about that. And the barman saying, "Sorry, are you with platform A or platform B? Because I'm on platform A, and if you're not on platform A, I can't serve you because your payment instrument doesn't work." Right?
Okay.
That's basically what we're avoiding.
Okay, well let's avoid that. It's a little bit like me going into my pub with a £10 note from Belfast. They don't like it.
Yeah.
Gunnar, just for you, just a few closing comments, because we need to wrap up now.
I think this was a great session. Thank you very much. I hope it came across where this solution is different and what kind of problems it can solve. And as I mentioned, you can come to us if you want to know more or try it out or whatever you want. Yeah.
Thank you very much. Andrea, and just a couple of last words from you.
And we are keen to work with the WOA community on this. The digital options are available. The WOA members are very innovative. They handle customers that often the banks have been struggling to finance, to put it this way. And so it's just a matter of daring to be the first one in the market with a more digital solution. I think it's trendy these days, so the risks are very low.
Excellent. Well, all three of you, thank you very much indeed for sharing your thoughts with the WOA audience. Thank you too to our participants, and really looking forward to our next session in 1 month's time. So thank you all very much, and I'll say goodbye. Thank you.
Thank you, John.